Tom Boley, Chief Market Strategist here at Earnings Beats. Hey, good morning, everybody, and welcome to this Tuesday, January 7th, 2025 edition of Trading Places Live at earningsbeats.com. I'm Tom Boley, Chief Market Strategist here at Earnings Beats, and it's a pleasure to be with you all this morning. Looks like futures turning back up again. Action on Monday was kind of mixed. I thought we had a really good morning session. Everything looked good. We saw a lot of the major indices higher. We had some key breakouts. And then the afternoon happened where we got a lot of pullbacks. Some breakouts held, some others didn't. So today we'll take a look at some of those and kind of try to glean what we need to see as we move forward to maybe forge this breakout and see maybe the market move back up above the key areas, key levels that we or recent highs. We really like to get to all-time highs. Of course, areas like the Dow Jones, the small caps, the IWM, the mid cap. That's the MDY is the ETF that tracks it. Some of those areas have quite a bit of ways to go to get back to all-time highs. S&P 500 still has a little bit of room, a couple percent. So that's what we're looking for. That's what we'd like to see, another breakout to the upside. As far as the sustainability ratios, some of the things that I look for to suggest that we'll continue to move higher, those ratios for the most part look pretty good. They're not perfect, but I would say they're much more bullish than bearish. We have seen money continuing to rotate into more aggressive areas of the market. We saw that again yesterday. So we had the major indices for the most part yesterday powering to the upside, and we finished with some nice gains on the NASDAQ, but we did give them away in some other areas, the Dow, the small cap IWM, and so forth. But we did lead with some of the aggressive sectors in the market, which I'll show you here in just a couple minutes. So all in all, I thought it was a pretty good day. And so far here in January, we seem to be pushing to the upside with leadership in a lot of the right areas. Yesterday, we had a big breakout in the Semiconductor group. Been watching since June 22nd or June 23rd, since we put in that topping candle. Said back then, we need to be patient. This is a group that ran, I think it was 133% in 7.5 months. And so when they put that topping candle in with very, very heavy volume, it was a big bearish engulfing candle. If you look at the chart on the DJUSCC, you need a dollar sign in front of that. Dollar sign DJUSCC, USSC. I don't know if I got that wrong first time. But dollar sign DJUSSC, that's the semiconductor index on stock charts. And so that's where you would want to take a look at that reversing candle that I was talking about back in June. But we came back up. We tested that area a couple times, couldn't get through. Yesterday we got through. NVIDIA had a big breakout intraday, couldn't quite hold on at the close. It was very close. We did get a breakout to an all-time closing high on NVIDIA, which was good. But we were also well off the earlier high, almost $3 off the earlier high, and we barely closed higher. So it was one of those where, yes, it's a breakout, but certainly could have been a much better breakout, maybe a much more confirmed type breakout. But this morning, let me give it to you. I think NVIDIA was up pretty nicely, at least earlier. Yeah, it's up almost $4 today, pre-market. So with 27 minutes to go to the opening bell, NVIDIA is at 153.22. If we open there, that will represent the all-time high on NVIDIA. So that group, talking about that at our Market Vision 2025 event, but that group is really starting to strengthen again, and a breakout in semiconductors and another push to the upside there, going to make it really difficult for the bears here early in 2025. Also, we want to keep an eye on January because of the January effect. At least I call it the January effect. There are other names out there, but I like it because January does have a quite obvious effect on the balance of the year performance in our major indices. And I'll be talking about that more as we get closer and closer to the end of January. But essentially, if I go back and look at all the years since 1950, if we finish in the top quadrant, so if you go back to 1950, that's like 75 years. So the top quadrant would be like the top 18 or 19 years out of the last 75. If you finish with January performance in the top quadrant of January performance of all the years, that usually bodes for an extremely bullish balance of the year. So far we're off to a decent start, but if we get this breakout, confirmed breakout with semiconductors and then NVIDIA to follow, things could certainly be looking up. Anyhow, let's take a look at the action from yesterday. So got the key indices up on your screen. You can see the NASDAQ 100. That's where most of the strength remained. So we had, I know at one point, the Russell 2000 was up over 1% yesterday. It finished almost flat. We had mid caps up significantly, finished again just a little bit above the zero line. Transportation, same way. When we look at that chart, you'll see a tail. The high, intraday high, went right up almost to the 20-day moving average. And then we came back down and ended with a candle that looks like a shooting star or a gravestone doji. So we'll look at that candle and I'll show you what I'm talking about. But that's partly the reason why transports, Russell 2000, why their AD lines don't look strong is because even when they have a strong day, it seems like they're weakening into the afternoon. And if you know how that accumulation distribution line formula works, it's looking at the whole day's activity, but where you close dictates whether or not that AD line goes up. You have to close at least above that middle point, the middle of the road of the candlestick for that day. If you finish in the lower half, you're going to go down with your AD line. If you finish in the upper half, you go up. So anyway, we'll look at those charts in just a minute. But anyway, NASDAQ did well. S&P 500 up 0.5%, closing back in on 6,000, just 25 points away. But we got to get back through that 6,100 level and ultimately break out. That's why we're still a little bit more than 2% away from what I would consider to be a big breakout there. Let's go over and take a look at the sectors. Pull those up here. So you can see technology up 1.27% yesterday. Communication services a little over 1%. Consumer discretionary up almost 0.4%. Those are the three most aggressive areas, and they're in position 1, 2, and 4 on an up day. So anytime, the thing that you've got to worry about in the stock market is when we go back up and we move back to all-time highs and we continue trying to push higher, but we do so with defensive groups leading. A lot of people get it wrong. They hear me talking about, well, you don't want defensive groups to lead. And you'll look at the market pulling back and defensive groups lead. And I'll hear questions about, well, isn't this bearish? Defensive groups are leading. Defensive groups almost always lead when the market's going down. They hardly ever lead when the market's going up. So if we have a consistent pattern of new highs being generated, new all-time highs, or just a rally in general to the upside, and it's being led by defensive groups, that's when I would be very much concerned about at least that one signal in the market. There's a lot of different signals, and this is a secondary signal, watching where the rotation is going. That's a below the surface secondary signal. Primary signal is always price volume, always. Are we breaking out? Are we losing moving average support? Are we breaking a trend line? Have we lost gap support? Are we breaking above gap resistance? I mean, those are the things that are most important to me. But all these other things that I talk about, whether it's the sustainability ratios, whether it's the rotation between offense and defense, risk on, risk off, that sort of thing, growth versus value, those types of things are secondary indicators, but that helps us feel more confident about the advance. Anyhow, down to the downside, look at the bottom three as we move up to new highs, or not new highs, but a high yesterday, upward action, whatever you will. Consumer staples, utilities, and real estate, three defensive groups down at the bottom, all losing more than 1% on the day, while you got technology, consumer discretionary, both over 1% higher, and then even discretionary rising almost 0.4%, comparing that to staples, which dropped 1%. Those are some of the ratios, and that's some of the rotation that I like to look at just for further confirmation. So I like what I'm seeing here in January, and even in December, when we pulled back, it wasn't so much the aggressive groups. It was more, a lot of it was defensive groups that were underperforming pretty badly, more value-oriented stocks and such. All right, 10-year Treasury yield. Let's get a quick update. Make sure I got the latest here. We are currently up 1 basis point on the 10-year Treasury yield to 4.63% from yesterday's close, which was just below 4.62%. Nice, looks like a little cup off of this uptrend. So breakout, well, maybe we get a little bit of a handle first, but I wouldn't, it's a small cup though, so I wouldn't look for much of a handle if this is a pattern that you're following. I mean, the big thing for me is we're just trending higher. We got a major resistance level at about 470. And then ultimately, if we stretch this out to a 5-year, you'll see we had gotten up to 5% back in October of 2023. So that was right at about when that correction that we had in the summer. See the streak right here from July through October, really strong move up in the 10-year Treasury yield. That was from about 4% to 5%. And if you look at the S&P 500 over the exact same time period, that is where we fell from July through October. That was the 10% correction that we had. So I've talked about the market being potentially choppy, especially early in 2025, because we really have no guidance what to expect from the Fed. I mean, the Fed was very, very dovish, talking about all these rate cuts coming. And then the last time they met, talked about the fact that they're going to lower the number of rate cuts next year and that they're concerned about inflation because it's being a little bit stubborn in going down below the 3% level. It's hanging and right now sitting at about 3.3%. That's the annual rate of core inflation. So still got a lot of work to do with inflation, according to the Fed. And as a result, anytime that we're getting these moves to the upside in the 10-year Treasury yield, you have to question whether or not it's money rotating out of the bond market, sending yields higher because of an expected economic, additional economic strength, because you would get out of bonds for that reason, right? Because you want to be in stocks. I mean, if the economy's picking up, S&P 500 company profits are going to go up, multiples are going to expand. And so you're going to make more money in stock market than you are in the bond market. So that's why folks will get out of bonds, sending the 10-year Treasury yield higher if the economic picture is improving. But the other reason that folks would get out of bonds is if inflation persists and they feel like inflation's a problem. Because right now, 10-year Treasury yield sitting at 4.63%. If inflation were to rekindle and get back up to 5 or 6% again, do you want to be stuck holding a 4.63% 10-year Treasury yield? You're losing money to inflation. So that's another reason folks would get out of the bond market. But when they get out of the bond market, they're not going to get into the stock market. They're going to move to cash, or they're going to move to gold, or they're going to find other hedges. They're going to see areas like real estate doing better. So looking at the other markets can help you determine why rates are going up. And for me, I'm still seeing areas going up. Growth is leading value. Well, that's not because of inflation. If you're worried about inflation, you get the heck out of growth stocks. You don't pour into them. You don't go into technology and communication services and discretionary stocks. Go back and look at the cyclical bear market in 2022, when we actually had movement to the downside, and see what was hit to the downside. It was the aggressive stocks that got hit, not real estate. I mean, real estate probably went down as well, but on a relative basis, that's an area that's going to perform better. So it's not just about seeing interest rates going up and saying, oh, that's bad for the market. It actually could be a good sign for the market if folks are getting out of bonds and moving into the stock market. Now, there is a level at which I would be worried about yields. And I think anything above 5% definitely would have a little, red flag would be going off in my head if I see the 10-year Treasury yield over 5%. Now, where does it actually become a problem? Where is it too high for the economy? I mean, we could argue. I'm going to say it's somewhere between 5 and 6%. So anytime we go above 5, I'm going to be nervous. And the market was nervous 2 years ago. But again, I think that move to the upside had everything to do with inflation. And every other area of the market kind of confirmed that. Stock market went down while the yield was going up. We saw defensive areas outperform, aggressive areas get clobbered. I mean, NVIDIA was a $100 stock before its 10-for-1 split. So now it's $150 after a 10-for-1 split. So that's like 100 or 1,500. It was only 100 2 years ago. It's gone up 15 times. So growth stocks got crushed back in 2022. You've got to understand, try and put the story together. with the stock market. You can't just look at the S&P 500. You can't just listen to the perma bulls, the perma bears. You have to look objectively at what's taking place in other areas of the market. And that's what really we try to do. And I think we do better than anyone. S&P 500. Still got this potential head and shoulder top. I mean, when you look at this reversing candle, I'm going to zero in here at the very end. But you can see left shoulder, neckline, head, neckline, right shoulder, still kind of in this right shoulder down to the neckline area. But remember, this pattern, it's a bearish pattern if it confirms. It haven't confirmed yet. So sometimes these patterns look ominous, and then we go right back up and break out. So that's why for me, S&P 500 getting back through 6,100 would be very important, because at that point it negates this potential bearish pattern, because none of these patterns are bearish until they execute. I think that's a big mistake that a lot of traders make. They see bearish patterns and then they start protecting their portfolio before we ever get a breakdown. And so you get more defensive, or you move to cash because you're afraid of a breakdown, and it doesn't happen. Then the market goes up. You got to figure out how to get back in the market. So for me, again, it's really about the confirmation, the execution of the pattern, not simply recognition that one's out there. NASDAQ 100 got the 50-day test. I mean, I still see a really nice uptrend. Yesterday was more of a doji, where we opened and closed at about the exact same level. 21,551 was the open, 21,559 was the close. So that's a doji candlestick. Just a little bit of indecision is what that tells us. Not necessarily bullish or bearish. After an extended uptrend, it can be a reversing candle. After an extended downtrend, it can be a reversing candle. But you need to have confirmation of that. And we're so close to the support area, I really wouldn't. I mean, to me, that's the non-factor. I'm not really looking at this necessarily as a reversing candle. I think we're just in the middle of a range of consolidation between just below 21,000 and just above 22,000. That's the current range for me. IWM. So IWM, this was kind of an interesting candlestick, because we had the double bottom in play. In between was a high at around 226 or 226 and change. Intraday yesterday, we had it covered. If we had gotten this breakout, if we had finished above the 20-day moving average, that would have been really bullish, because it would have cleared that top in between the double bottom. And the double bottom, I mean, I'm thinking right around this 217 down to 215, right in here is pretty good price support. And we were down in the 217s, I think, just last week. So getting back up and through 226, 227 is the very first step to going back up to the 240s and challenging those all-time highs. So had a reversing candle here, though. We were through the 20-day. We failed to hold it and came back down off this uptrend. A little bit of a shooting star candle there. There are better ones, though, or maybe better gravestone dojis. We'll take a look at here in just a minute. But that's the IWM. So let's get through the 20-day moving average there. With futures up, let me see where we are right now on IWM. Up about 0.5%. We're at 225.61. So 225.61 is still a little bit below the 20-day, which is at 226.23. So we got to extend that move to the upside, set a new recent high, and close above that 20-day moving average. I think that would be a really good short-term sign for the IWM. Transports. Now, this is where I was looking at that shooting star, maybe even like a gravestone doji. Look at this. We get up, basically touch that 20-day moving average and fail. This is what downtrends look like until we get that move back through the 20-day moving average. And what I'm talking about is when you break below the 20 and then the 20 breaks below the 50 and the PPO goes negative, that's a bearish setup. Until the market rights itself, you can't just assume we're going back up. So when we go up and test the 20-day and we fail and come all the way back down to the low of the day, that ordinarily for me would be looking like a setup to go lower. Now, we've seen a lot of head fakes in transports and in the IWM. Maybe this is another one, this failure at the 20-day. Maybe it's a head fake. Maybe we do break out, but we need to see it, because that's a pretty steep drop. 2,000 points from 17,750 to 15,750. I mean, right there is more than a correction in a month on the transport group. So, trying to get this and trying to get back through this 20-day moving average, I think is going to be really critical. for the transportation average. All right, so a couple of things to look at. First, the MDY, which is the mid cap. You can kind of see that break, just like the IWM. We broke out. We failed to hold the breakout. We failed to break above this top, which is in between the double bottom. And also, look at the mid caps, that 560 level, really important. So a failure at the 20-day moving average, and then ultimately a close back below 560. Forget about what else is happening in the market. That would be bearish development. I mean, it's hard to sugarcoat that. I mean, again, PPO is negative, showing bearish short-term momentum. And I say short-term because if we look at a weekly or monthly chart, long-term chart on the MDY, we'll see a different picture. We actually do have an uptrend in play. But you can't break your long-term uptrend until you start to break more short-term uptrends. And so right now we have a broken short-term uptrend. We're now in a downtrend, and now it's up to the bulls to get back up above that 20-day moving average and start to try to right the ship here. All right. Before we get into more charts, I do want to mention, for those of you who are new to Earnings Beats, if you go over to earningsbeats.com, both plural, earningsbeats.com, we did have our Market Vision 2025 event on Saturday. It was a great event. Lots of positive feedback. I want to again thank David Keller, who joined me for this Market Vision event. He talked about his different scenarios where he sees the market going in 2025. Of course, I gave my outlook for 2025. So far, over the last 5 years, I've hit the direction, which way the market's going to go, 5 times out of 5 years. Haven't missed yet. Knock on some wood here, maybe up here. But anyhow, if you want to go back and look at it, we do have 4 hours, over 4 hours of on-demand recording. So we've got a special for members. So if you click on that link, it will bring up this landing page where you can go back, check out a couple of different options. You can buy any single session for, well, you'll get my trading tip. So last week on our free EB Digest newsletter, I had 3 trading tips for 2025. And then I talked for about 20, 30 minutes about the most important trading tip for 2025. And if you decide to purchase this recording, this would be part of it that you would get, but you can get this standalone. So you can just follow the landing page and you can check out this, or you can get the entire recording, including Dave Keller's forecast, what he's looking for as we move into 2025. And then all of the things that we talked about at Market Vision 2025, including my forecast for 2025 and where I think it's going and why. That's the more important reason, is why it's going to head in a certain direction. But anyway, you can go to this landing page, check it all out. On your screen, we've got a QR code where you can click or scan on that QR code, and it'll take you to the landing page on your mobile device. So trying to make it easy for you. But definitely check that out. I think it's the best event of 2025. And, with this recording, you're going to get 1 free year of membership at Earnings Beats. This is a $997 value that you're going to get with the purchase of this recording. And the recording is $100 cheaper than the actual live event was. So save $100 there, get a full year membership. It's a great deal. Hopefully you'll check that out. All right, let's keep moving here. Got some more charts to go through before we wrap this thing up. So let's take a look at semiconductors. Here was that June reversal. And I probably could go back. Let's go into the articles back here. I'll show you how you can go back and look at these archives, by the way. So if we go to my blog, Trading Places with Tom Bowley, then you can look at blog archives. This was an article I wrote in June of 2024 about semiconductors. So you just click on June 2024 and it brings up the articles right here. June 22nd, the semiconductors have topped. Look elsewhere for opportunities. Couldn't have been any clearer. And that comes down to this massive reversing candle on extremely heavy volume after We'll go back a little bit further here. This was the low at the end of October, down just below 9,000. And then we went up to 21,000. 9,000 to 21,000 is 12,000 points. 12,000 divided by 9,000 is 133%. A 133% move. And I had no magic, crystal ball, but what I do have is common sense. When you get any area of the market that goes up 133% in 7.5 months is way stretched. There's nothing I'm aware of that normally goes up at that kind of rate, anywhere close to that kind of rate. Even if we look at semiconductors and say their average annual rate's 25% a year, which is high. I don't think it's that high. I don't think it's anywhere near there. But let's say that's what it was. Still, 133% in 7.5 months is crazy, and it's not sustainable. So we needed this period of consolidation. And I think semiconductors are great companies. I think the rate of growth in this industry is crazy, and it deserves higher multiples. The stocks within deserve higher multiples. In some cases, extremely high multiples. But after you've made that kind of a push with that kind of reversal on that kind of volume, it's time to take a break. And that's what we did. You can see 21,000 was never taken out until yesterday. Now, will it amount to anything more? I don't know. NVIDIA, here was the breakout on NVIDIA. Of course, NVIDIA is the leading semiconductor stock in the world. So NVIDIA trying to make the breakout failed. But today, as I pointed out, let's get the latest. NVIDIA right now in pre-market 153.22. That's up $3.79 at 2.5%. So we're all the way back up above where we, above our high, intraday high from yesterday. Also our intraday high from November 21st. So NVIDIA is back in breakout territory again. And I've said recently, I said at Market Vision 2025, I'm looking for NVIDIA to break out and make another run. And it could be happening right before our eyes right now. I think NVIDIA is a really good buy and hold. You got to take risk. You got to be willing to take risk. It's in the semiconductor area. If it turns out sometime this year we have a recession, stocks like NVIDIA are going to get hit, and they're probably going to get hit hard. So it's not like there's no risk involved. You've got to be willing to take the risk that we're not going to have a recession, that growth stocks are going to prevail throughout 2025, and that NVIDIA is going to make this breakout and sustain it to the upside. And if you're not comfortable with that, you don't want to take that kind of risk, that's totally understandable. But for those who are risk tolerant, that have more risk tolerance, maybe younger, or maybe just, have it in a portfolio where they're looking for growth, NVIDIA, I think presents a great opportunity here. Internet stocks. So internet stocks, you can see making another move. We already had the breakout. Here was the big breakout. We had a nice little cup handle, move up, came back down to the 20-day moving average, almost to the area where we broke out from. And now going back up, today could be another breakout here. Getting back through about 52.25 would do the trick. We closed at 52.08. So stocks like Google making the breakout yesterday, volume increasing. How about Meta? Meta, after that recent pullback, last few months, kind of been going sideways. Looks like it's on the verge, possibly breaking out. Watch the 640 level. Breakout above that would do it. You can see volume starting to pick up here in the new year. So I think Meta could be next. Another group, software. Talked about software. Here was the breakout from 7,300 right here. Went back down, set a low at 7,200. So I'm calling 7,200, 7,300 as the key area of support on software. We went up, we failed at the 20, just like we did a week and a half ago. So first thing we have to do is get through that 20-day moving average. If we can get through the 20-day, then you've got another key area of the market looking strong. And so when you take a look at software, you think Microsoft trying to bounce back through its moving averages yesterday, failed at the 20 and 50. Let's see if we get through. If we do, Microsoft could just be starting a move back to the upside. There's a lot of other software companies that look really good, though, to me within that space. So Microsoft, I just wanted to point out because most everyone knows Microsoft. Another area, computer hardware, big breakout. We saw that in December. Recently, over the last week, we've pulled back, but we got back to 12,000. Where was the high back in July? 12,000. just under. So all we did is went back, tested an area where we broke out from. Yesterday, we reversed course. Instead of putting in lower lows, lower highs, we put in a higher high and a higher low. But we got to get through that 20-day moving average, which I believe is coming. So, of course, when you're looking at computer hardware, we look at Apple. Apple also trying to get back through its 20-day moving average. All right, one stock, I was looking at our raised guidance chart list, and I thought Paychex looked kind of interesting because after they raised their guidance, which came in the middle part of December, this was a prior low. It's also kind of in here around this gap support area. And after we got the raised guidance, we went up to $142, $143, and now came all the way back down to 136, actually printing a slightly lower low than what we just saw 2-3 weeks ago. And sometimes that's how bottoms form, where you have just a low that's slightly below the last one. But overall, I see this as a move to the upside, pull back to test key area of support. This is where we gapped up from 135 and change right here. This is where we gapped up from when the guidance was raised. So we got up to 142, 143. We're coming back and we're revisiting this area where all the buyers jumped in. So this is an area that I would watch pretty closely, and I have no problems with a position in Paychex right here. If it closes back down below, give it down to gap support, maybe 133 and change. But if it closes below that, you get out with fairly minimal damage to the downside. And this could be a reversing candle that takes it back up to a new high. So I like to buy pullbacks. Call me crazy, but I like to buy stocks when they come down and they're cheaper. I don't know too many people that, go out and they go shopping for a suit and they're like, oh boy, suits just went up 20%. Let me jump in. I don't know about everybody else. I'd rather buy that suit when it's on sale. That's the same way I look at the stock market. I like to buy good, healthy stocks when they're on sale. And, it's almost like if this was a suit, if we lose on it, we could just take it back and kind of get our money back, or almost every penny of our money back if we didn't like the suit. You know what I mean? So anyhow, that's Paychex. I think that stock looks pretty good. But go through our raised guidance chart list. I find so many solid trading opportunities as I go through all of our chart lists. But raised guidance is one of those because management just talked about better prospects 2-3 weeks ago. And here we're getting it at the lowest price that it's sold at since management came out with that bullish news. It just kind of makes sense from a fundamental perspective as well. Anyway, that's it. Let's see where the market is, and then we'll wrap this up. So we got the Dow right now up 1/3 of 1%, S&P up 0.4 of 1%, NASDAQ 1/3 of 1%, NASDAQ 100 only up about 0.2%. Small caps up over 0.5% on the S&P 600. Let's take a look at the IWM, see where that is. Up 0.73, so that's almost 0.75 of 1%. And we are at 226.17, which is just 6 pennies below the 20-day moving average. And also, this is a level that we broke below here. You can kind of see there's been a lot of pivots right around this 226 area. Tops here, top here, gap above here, pull back to 226, then a new high, and then big volume breaks 226 to the downside. So is this just a test of 226 before we roll back to the downside, or do we get back through? Because if we get back through, in my opinion, that would be the most bullish short-term signal we can get. Price action, getting back and closing through 226 and that falling 20-day moving average. So look for that. Anyhow, that's it for me. Appreciate everybody tuning in. Be sure to check out the Market Vision 2025 recording. That's going to be one of the best things you're going to look at all year. If I'm right, you're going to want to know what I had to say in that event. So anyhow, check that out. Appreciate everybody watching. Make sure you hit the like button, subscribe to our channel, and that way you'll make sure you get all of our content throughout 2025. Have a great day, everybody. Happy trading.